Okay, so Fannie Mae and Freddie Mac updates. Hopefully you had a chance to read the emails that went out regarding Fannie and Freddie. This is just kind of like a 30,000 foot view of what they're looking to do, and a general overview of what Fannie and Freddie are and how they regulate lending for homeowners. So we do have 25 minutes left in the webinar, so I will try to make this as quick as possible. All right, while we're talking about this now, Fannie and Freddie did put out new regulations. They do this from time to time, and usually they're pretty easy to adjust. There was a big adjustment after, if you remember, the Surfside condo down in Miami that collapsed, unfortunately. So lending regulations like Fannie and Freddie came in and said, we need to make some changes. They made some changes then, and they're making changes now. It also kind of adheres to similar type situations. So with these new regulations, we just want to go through and make sure you have an understanding of what this means and how to prepare for it. Some key dates: March 18th is when they announced these updates. July 1st is some insurance changes. We're already ready for that, but we'll go through that in a minute. August 3rd, we got unlimited and streamlined review is going away. We'll talk about what that means. And then on January 4th is the big one. If you're going to pay attention to anything in this presentation, it is this one, which we'll talk about in just a second, the minimum reserve allocation. So roadmap, basically the same as the timeline, what we're talking about. So we'll hit these relatively quickly, probably spend the most time on reserve contribution increase. But outside of that and reserve studies, we're going to have you covered for everything that comes up with these changes. But the reserve contribution and the reserve study type things are what we need boards to be aware of and start preparing for. All right, so first off, what are Fannie Mae and Freddie Mac? A lot of you, if you don't know who they are, you've probably heard of them. They are a government-sponsored enterprise that just helps with the conventional mortgage market. They're kind of backers for these lenders and making sure that they get your standard conventional mortgage, and they generally provide your best option for lending. You've checked all the highest boxes when it comes to like the lowest risk. You hit all the Fannie and Freddie regulations, so we're going to provide you with this loan borrower so that you can get this home. So this is really a lending regulation that is changing. It's not directly an association regulation. Fannie and Freddie don't have an impact on the association directly. It is through the lenders that provide the loans to the homeowners. So, all right, so the big one, and we'll start with it, reserve contribution increase. Actually, before we start with this, I want to mention one more time while it's being recorded. For those of you in a possible business park, for those of you in townhomes, it's important to review your documents to see how you're actually defined. We have seen business park defined as condos and be under the Georgia Condo Act. If that's the case, you're likely going to need to know this information. Townhomes the same way. Sometimes lenders treat townhomes like condos. So you're seeing some of those questionnaires come up from lenders. They ask the same questions that they asked of condos. So if you're not sure, start with us. Ask your manager, reach out to us and say, hey, we're not sure. Can you look at, one, our governing documents, see how we're defined? And two, can you look at the history in your closing department to see if we've had to provide closing questionnaires in the past? Again, if you've had to provide any questionnaire within the last year or two, it's going to be safe to default to, we need to adhere to this if we want homeowners to get conventional lending. If you've never sent out a questionnaire, kind of at your own risk if you want to do it without adhering to this. So yeah, please reach out to us if you are unsure and we can help you with that. All right, so reserve contribution increase. The way that Fannie and Freddie have written it to date is you have to put in 10% of your assessment income into reserves. We'll show an example of that in a minute. This new restriction as of January of 2027, January 4th, is you have to put 15% in of the regular assessment. So it's not taking all of your income and saying 15% of it. It is your regular assessments. Now it says 15% or what the reserve study specifies. That's where the challenge is going to happen. It's not It's not easy, but it's not as difficult to jump from 10% to 15% if you're sitting at 10% right now. What may be difficult is if your reserve study with the numbers they're suggesting could actually be 30%. Well, the way we interpret this is that Fannie and Freddie are going to take whichever's higher. So it's important to make sure that you understand your reserve study and know what the amount needs to be if you want homeowners to get lending that's backed by Fannie and Freddie. The reserve study is crucial, and the lenders are going to look at it more than they used to. So we just need to make sure that that is being utilized. Now, what we're going to do, actually, let me show you an example first. So just quick, easy numbers. If your regular assessments, it's $500,000 a year, easy 10%, you put in 50 a year, and you've adhered to Fannie and Freddie's past regulations. That jumps to 75 as a 15% reserve transfer. That can be significant for any kind of community for when you break that out by however many homes you have, just that 5%. So we need to make sure that funding is there if you want your homeowners to get this type of loan. And we'll talk about that a little bit more in a second. So the reserve study expectations, like I mentioned, when a reserve study is used, the lenders are looking at that to see how do we compare the reserve study to the budget. They're no longer going to look at the second bullet point here. They're no longer going to look at what's called baseline funding. Some reserve study companies will provide an option for baseline funding, and that's basically like a net zero type funding. It's saying this is how much money you need to put in the reserves to plan for your capital expenses for this year if you wanted to net zero. Fannie and Freddie regulations aren't going to allow that anymore. They're saying you need to prepare for the future. You need to make sure everything is maintained as it can possibly be when it comes to capital expenditures, and you're prepared for those big items like roofs and siding and asphalt, things like that. So they're no longer going to look at that baseline funding. They're going to look at the max amount the reserve study is asking for that transfer. So if you have an older reserve study, and by older, I would say more than 4 years, it will be important to get that updated. We want to have realistic numbers. We don't want it to backfire, because one of the things lenders are going to do with the backing of Fannie and Freddie is going to say, your reserve study hasn't been updated in 9 years. We can't really rely on this. Because of that, we can't approve this homeowner's loan. You may see things like that. If you don't have a reserve study, same thing. You have no reserve study, so this community, we can't loan to somebody because you don't have a reserve study that shows that you're preparing for the future. Now, this is all lender specific. Like, we can't say that all lenders are going to say that or not say that, but it's more likely that they're going to say that with these new regulations from Fannie and Freddie. Before I move on, one thing you're going to see from us as we present our initial draft budgets. As a company, we will present a draft budget to you, and it is going to include that minimum dollar amount into reserves based on the 15% or reserve study, whichever is higher. Just want to make you aware of that so there's no sticker shock. Like, that first draft is going to say, hey, if we want to adhere to the Fannie and Freddie regulations, these are the numbers that we're looking at. So that's going to be a first draft from Access Management. Just keep that in mind. We're not trying to say, all of your homeowners need to pay 30% more. We just want to make a realistic presentation of what that number looks like if you were to adhere to this new regulation from Fannie and Freddie. So you'll see that as budgets start to come out. The process changed with the limited and streamlined review. That's going away. So lenders were able to, in the past, use a streamlined type of review of the community to say, all things considered, this looks like is in good shape. We don't need to dive into the reserve study. We don't need to dive into the budget. They have plenty of money. We're good. We're going to do a limited review, approve this, and move on. That is going away. So they're going to do a full review every single time somebody tries to get a loan in your community. And what that means is they are going to fully review the reserve study. They are going to fully review the budget. They are going to ask more detailed questions about deferred maintenance and planning for future capital expenditures. So on us, we're going to see a lot more questions from lenders. We're ready for it. We've worked with attorneys already with the last regulation that Fannie and Freddie put in to help with the wording on how we answer certain questions. So we'll be ready for these full reviews that'll come up just to make sure we are answering it properly, because we have to answer it truthfully every single time. We don't want to get into the world of mortgage fraud. Like, whatever exists is what we're going to put on these answers to the questions from lenders. Steve, any questions before I move on from here?
No.
All right. All right, project documentation and lender questions. These are the things, again, we're handling for you. We're going to have all this readily available for the lenders when they ask. We do work with a third-party online company for things like this. Makes it very easy for people like lenders and realtors to get this information online. So things like budget that will show the reserve contribution, simple financial information, balance sheet, income statement, reserve study, insurance coverages. When it says delinquencies, it's more of they're asking how many people are over 30 days late or over 60 days late. We're not sending a delinquency report with names and addresses. It's just general numbers. They're going to ask if you are in any litigation. We usually don't include litigation, meaning collections from a homeowner. Litigation meaning somebody actually filing a lawsuit one way or the other from association or from homeowner going against the other entity. So not including collections. They're going to ask if there are any special assessments. And if there are, they're going to dive deeper. What's it for? Are you on track? Has the work been done? Once the work is done and the special assessments are collected, are you going to be in good shape financially after that? And probably the hardest one is asking about deferred maintenance or critical repairs. Hard to answer that when you're an association or a management company, because most lenders, and Fannie and Freddie included, don't necessarily know what they're asking when they just ask, do you have any deferred maintenance? We've seen it asked that way. It's such a broad question, so we have to give it a broad answer when it's asked that way, because we cannot define what is deferred. And I think that's why they are one of the reasons why they're diving a little bit deeper to say we got to review reserve studies to see what might be deferred compared to the financials in the budget. So these are things, again, we have ready for them. Anything unusual comes up, we may pull in the board, but that is rare. We usually are able to handle these things and get it taken care of. All right, so a new update for insurance requirements on the master policy. They're requiring that you have a policy that covers everything. If the whole complex was to burn down, you need a policy that will 100% rebuild it that was originally built. And they call that full replacement cost. So the best case scenario, and it's very hard to get these days, best case scenario is you find a lender that will provide what we see here is guaranteed replacement cost. So that means the insurance carrier was able to do their own math to figure out what they think that would cost to rebuild the whole complex. But regardless of what it costs, if the whole thing was to burn down, they're guaranteeing that replacement. Now, if you cannot get that, then you have to talk to your insurance provider. What are these other options? What else can we do? Because you may need to prove that you have 100% coverage. So you may need to pull in insurance estimate professionals to say we need basically an appraisal to come out and see what is our complex worth if something was to happen. So this is one of those where we really need to lean on the insurance professionals to say they are very aware of what's coming with Fannie and Freddie. It's like, knowing this and our current policy, do we need to make any adjustments to make sure that we adhere to this if the board wants to 100% try to adhere to all these new Fannie and Freddie regulations? So this is one of those, what they're requiring is 100%. Let's talk to our insurance carrier to say, where are we now? Where do we need to be? I would even recommend doing that every 2 or 3 years. Most of the brokers that we work with, if you work with a broker that primarily works in association insurance, they're going to be familiar, they're going to be honest, and they're going to tell you, here's where we're at now. Here's where we need to be. Whenever you change carriers, a good time to have that conversation. If you change brokers, great time to have that conversation. Or if you're just interested, they can help us anytime we need their input. Third note there, the roofs have to be included. I mean, as long as the association is required to maintain them, we need to make sure that they're included as being insured. But yeah, like I said, we want to coordinate with insurance professionals just to understand that coverage and to make sure they have the proper documentation to provide to lenders and to homeowners that shows that proper coverage. All right, so one more thing with insurance requirements. This is actually a benefit to a lot of associations. They are changing the maximum allowable per unit deductible for master policy to $50,000 per unit. I can't remember what it is now or what it was before as far as the lending regulations, but $50,000 per unit is pretty hefty. Could be worth looking into with your insurance carrier if you wanted to go that route to see if it may save you some premiums, or, we have some condos that have trouble just getting binding coverage at all. Could we get coverage if we changed our deductibles? One thing to be mindful of is it says per unit for required property insurance perils. Required is basically your big things like fire. It doesn't include water. So if you have a plumbing backup, this does not apply. What we don't know, I say that, but what we don't know is if the lender is going to apply it, right? So the way the association wording is for our industry, it says required property insurance. The Georgia Condo Act says you're required to have things like fire, but you're not required to have things like water. Now, Fannie and Freddie and the lenders that are working with them may require the water. So just be careful. $50,000 per unit, I think is generally high enough, even if you include the water deductible in that. But another thing to be mindful of is looking at your documents to see how much of the deductible can be charged back to a homeowner in an insurance claim. Most documents will say if a home is involved, that homeowner is responsible for the deductible amount, and that's usually paid by their own insurance. But it'll cap that. Georgia Condo Act caps that at $5,000. Your governing documents may cap it at something less than that, could be $1,000. So if you have $50,000 per unit, just know if you're capped at $5,000, the association is going to be out the other $45,000. So something to take into consideration when you're talking to the insurance professional and working with the manager to say what makes the most sense for us as we try to factor in how do we get good coverage, how do we make our premiums as low as possible, and how do we make sure we're as protected as we can when there is a claim and we're not out of pocket thousands of dollars. So we just got to weigh all that out with the insurance professional input. We're talking about what the homeowner is responsible for. In any case, however your policy is set up, homeowners will need to have their own policy, which is called an HO6 policy, that basically covers what the association policy does not. So it can be a per unit deductible for the association. It can just be one main deductible where it's split based on the number of units that are involved in the event of a claim. But whenever you do happen to make a change in your insurance, we got to make sure that we're communicating with the homeowners what those changes are. They need to be aware of it so that they can update their individual insurance policy accordingly. What we generally tell homeowners if they reach out and say, what kind of insurance do I need? You say, hey, here's the association's policy. Talk to your own carrier. Here's the association's carrier's contact information. Let them talk just to make sure everything is perfectly lined up, because we don't want to take you in the wrong direction and mislead you by any means. We don't want you to be underinsured. We don't want you to be overinsured. Let the professionals talk so that you're perfectly in line with your policy and the association policy. So that's a lot there. So I don't know, Steve, was there any questions rolling in with this?
Yeah, there's one question on the insurance, and then there were a few late questions on the reserve study and whether or not we want to back up to that real quick. But you kind of alluded to it right now. But like for townhomes, where HOA provides only exterior insurance, but the interior, the homeowner, it's kind of takes it or is responsible for it, right? How does this insurance requirement affect HOA insurance?
Yeah, I mean, it's just verify that. That's a community-specific type question. Like we see a lot of it in some of the other classes that we do. There's a difference between who's responsible for maintaining, who owns it, and who insures it. So work with us, work with the manager, work with the insurance provider, even the attorney if you have to, just to make sure that is actually the case. You only insure the exterior, because I have seen some condo documents that says, oh, you actually are the first up, the main policy that would step in if there was interior damage too. So we need to confirm that as well. But that if you're only insuring the exterior in this case, this wouldn't apply as much. And lenders should be able to see that when they review the policy, knowing that you're not covering internal stuff. So you don't need to have necessarily a per unit deductible. You would just have a per occurrence type deductible to say, regardless, the association is handling it all. So we're going to do a per occurrence type of deductible, whatever's best for our policy, and then just handle it that way. So I would think lenders would look at that and understand that, you know, the units aren't involved, and it should be a little bit of a benefit to your community when units aren't a part of that. Yeah, talk to your insurance carrier just to make sure that is the correct layout.
Good. Thank you. Maybe related to this, maybe related to something else. Did the max 15K water deductible change?
There is no max. Oh, that went away. Yeah, forgot about that. So that's what they had in there before, and they just got rid of addressing water at all, or anything else that you said. 50,000 per unit required property insurance barrels. So that applies to everything. Again, to be safe, I would apply it to water as well, because they look at what's required differently than how associations look at it. So yeah, it's just $50,000. I would just, for easy sake, just say that's across the board.
Great, thank you. Some of the rest are just kind of reserve study questions. You want to do it now or just at the end of the session?
Let's wait till the end, and we can bundle it with the other questions that come in.
Great.
We can try to get through it. All right. Maintenance, critical repairs, and special assessments. We talked about this a little bit. These are the things that the lenders are likely going to ask questions about. Do you have deferred maintenance? Are there any critical repairs that you aren't able to get to? We have seen where there may be evacuation orders based on the condition of the community, and generally anything that's unsafe. Now, I've never seen a lender actually go out to a community and check these things. They are asking the association, by way of us, to confirm these things. And that's where it gets complicated. And that's where we've worked with attorneys to have set answers to certain questions, unless we know that it should be answered a different way. Like if there's something that we've been talking about for 6 years with a community, it's clearly deferred maintenance. We just can't afford it now. We're working on it. We need to disclose that, because once they dive into additional things like reserve study, potentially minutes, financials, they're going to be able to find it. So we don't want to hide anything. So what we know, we have to disclose, but they're just asking these general questions that we are able to answer. Like we talked about before, special assessments, they're going to see what it's tied to. They're going to ask more questions to see why it was needed and what condition you're going to be in after the work is done for what was the special assessment was for, and then what financial condition you're going to be in after the special assessments are collected. So we just need to be prepared to document these things when these questions come up. Like when it comes to special assessment, a lot of times you may see it for a big project. You may do a special assessment to replace the roofs in the middle. Somebody's trying to get a loan. We're going to say, all right, provide all the documentation that shows the scope of work for the roofing, how you're funding it, when they're going to be done with it, all that stuff. And that's something we should be able to provide. As long as your contract is full service, we will be working with the contractor to know what's going on with that scope, to be able to provide it to lenders when they ask. And then asking about reserve planning based on what the reserve study says. Like it is recommending, going back to the roof example, it recommends you replace the roof in 2028. Do you have that plan for? Is it in your budget as you approach 2028? They'll ask questions like that. So just be aware of those things as they come up, because they will come up, and we can handle them for you. And we'll bring you in if we need some additional information that we may not have. So potential lending and marketability impact. So everything I just told you, I don't want it to create fear. It's not meant to say nobody's ever going to get a loan again because we can't adhere to this. There's no way, it's impossible. there are other loan options. Fannie and Freddie are your standard the conditional loans. They're the ones that you see, like I said, when people say home interest rates are at 6.25 and that's as low as I can get, that's the type of loan that they're talking about. So there are other options. So if the board decides, all things considered, it doesn't make sense for us to fund the reserves as much as the reserve study asks, or even the 15%, we don't want to put that on our homeowners. It is a conversation that needs to be had. But if that's ultimately the decision that it is made, there are other ways for homeowners to get loans. There are unconventional loan options. When you get into those, then homeowners are going to see potentially higher down payment requirements, higher interest rates, other terms that aren't generally required if you're going with a conventional through Fannie and Freddie. May take a little bit longer. We only bring that up to keep that in mind as you budget, because homeowners don't understand this. And this goes back to the transparency. I think it's important to communicate to all of your homeowners if that decision is made, or regardless of what the decision is that's made. Like you say, we're putting in 20% because that's what the reserve study says. It's going to be potentially sticker shock to your homeowners. Communicate what we're talking about today. We can help with that to say, this is why we have to do this. We want to make sure you can sell your home to a qualified buyer and your buyers aren't limited, right? We want to put you in the best possible scenario to sell your home if you find yourself in that position, or refinance your home. So think about communication and transparency with your homeowners, regardless of the direction that you take, so that they know why they're in the position that they're in, because we see it all the time, and they turn around and blame us. They blame the association when their buyer can't get a loan. So it's important for them to know why this decision was made, and ultimately it was made for the best for what we believe was for the homeowners in our community. If you want to go a step farther, we don't mind polls. We have an easy way to poll homeowners for anything that you would like. You can put out a poll to say, hey, look, here's 2 different draft budgets. You don't have to include everything, but here's what we're considering. If we're looking at funding our reserves based on what the reserve study says, this is what you're looking at for your monthly assessments. If we go below that, this is what you're looking at for your monthly assessments. But if we go below that, here's what happens when it comes to potential buyers. And which way would you like to go? If you were to vote on this, which route would you prefer to take? I think it's always beneficial to get the feedback from the homeowners. Yes, as boards, you ultimately make the decision for the association, but you're also trying to make a decision for what's best for the community. So if 95% come back and say, we're willing to pay more, and that was an unexpected response, the community's telling you something. So it may be worthwhile to poll your community in advance to say, this is what we're looking at. And then when somebody isn't able to get financing for one reason or the other, if they decide to go that route, you can kind of fall back on that and say, this is kind of what the community decided. This wasn't ultimately a board decision, but we let the community speak. This is the route that we took. All right. So that's basically everything about the Fannie and Freddie. So as far as you're concerned, like we talked about at the beginning, the big things to focus on as we go into budget season is how much needs to be put in reserves. Or do we even care? So you can have that conversation as a board. We don't care about having conventional financing. We're not going to adhere to this. But that is a conversation that needs to happen. It needs to be in minutes and recorded. And like I said, ideally communicated with your homeowners so that they understand that. And then a review of the reserve study. Does it need to be updated? Do you need one? Some people don't have one. Just an overall look. We have plenty of reserve study companies that we work with, a lot that have very detailed information that they provide, which I think sometimes we used to think it could be overkill, but now that's certainly not the case. The more that they can provide, the more beneficial it is to these lenders so they can review it. So there's less questions asked to the association to try to say, hey, what's going on with your community? And then look at some of these deferred maintenance items, critical repairs. If you're considering a special assessment, if you're considering a loan, talk to us, get the conversation going. Let's figure out if there is a way we can get these things addressed. How do we find the money to get these things that should be a priority when it comes to maintenance? You've probably been there before if you've been on the board for a while. Every condo goes through it. It's like there's just these things that it's not fun to deal with. Nobody sees it, but we have to do it. and so we just got to make sure those deferred maintenance items are at least discussed and planned for. What we don't know is if there's a plan, the lender may look at it and say, all right, we're good with that plan. You haven't done it yet, but we're good with the plan. So at least having that could help with potential lending. The next one, can the association quickly provide budgets, financials, insurance, all that stuff? We got you on that. We can do that for you. We have all the information readily available to send to them. And lastly, just like Senate Bill 406, if you have any specific questions regarding your own reserve contributions, reserve study, insurance, lending, please pull in the professionals, your insurance agent, your attorney, your reserve study agent, who can help with that. We want to pull them in just to provide the most knowledge that we possibly can so you have educated information to make your decision. With that, just real quick, just an overview of how we're preparing. Like I told you, we're going to present draft budgets for 2027. It's going to have at least a 15% or the minimum reserve study recommendation, whichever is higher. We'll review these reserve studies just to have a quick overview and conversation with the boards to see if we need to pull in other experts to do more investigating. These are flagging communities that may need further discussion based on what we see with deferred maintenance, reserve studies, things like that. And then trying to work with your insurance professionals to look at the documentation, the policies, and all of that. So just like SB 406, if we do learn more, if there are changes, we'll continue to communicate. But you will be reminded of this as you get your first draft budget from us to get that conversation going between us and the board on what you think is best for your community. Let's hear some questions.
All right. So in generality, how often would a reserve study need to be updated, where there could be situations maybe the reserve study doesn't accurately reflect present reserve amounts if, community potentially invested a larger surplus into the reserves last year?
Yep, great question. Our general recommendation is try to update your reserve study every 3 to 5 years. The more detailed it is and the more prepared you are, I think you can lean more towards the 5 years. The more behind, I think you need to every 3 years at least. What they're likely going to look at is they're going to compare that reserve study to what you're doing. So the more you can document and the more you can actually help a reserve advisor provide a reserve study, because they're going to start asking questions when you get your reserve study updated and say, what have you done? All right. And we can obviously help with this and say, we replaced the roofs in 2024. This is how much they cost. That gives the reserve professional an idea of what to project when it comes to next time you need a roof, more than just looking at the roof. They're very knowledgeable. They can look at a roof and say, we think it has about 12 years left, and they're going to put that in the reserve study. But if you can provide information up front, it's going to be much more detailed and much more correct when it comes to what's being provided to you for preparation and to lenders when they review this. But overall, I'd say every 3 to 5 years, just as a double check. And most of them will do a prediction out about 30 years. But when you update it every 3 to 5 years, those are more realistic numbers than what you're planning for.
Great, thank you. Are there rigorous standards in preparing a reserve study?
I guess that depends on the company you're using. Like I said, we have several companies that we work with. Managers have relationships with a lot of them. They can make predictions based on their recommendations based on their experience. It's generally pretty easy if you're updating it. So if you're doing a regular update, there's not much to do outside of what's happened in the last 3 to 5 years. Just provide me with that numbers breakdown of what we've done. If you're starting from scratch, that takes a lot more, because you're creating every possible thing that they're looking at, and they're going to come back with questions to say, what have you done with the crawl space? What have you done with the stairwells in the hallways? What have you done with the elevators? With the roofs? So they're going to get a lot more information from us in the association to better prepare that initial reserve study going forward. So depending on the scenario that you're in, if you're updating, again, not as much, but if you're starting fresh, it can be pretty time consuming and not cheap. I don't know what they're running these days. The last time I was involved with one, it was, I think, $5,000 to $7,000. So when we talk about budgeting for things like this, factor that in. If you need to do one from scratch, talk to your manager, get some quotes, like what are we looking at so we can budget properly. If you're doing an update, those are usually cheaper, but now's the time to start having those conversations with your vendors to say, what kind of numbers are we looking at just for budget purposes so we can plug it in for 2027, then we'll reach back out to you when we're ready to move.
Great, thank you. Can you distinguish between reserve contributions versus actual reserve balances required by a study?
So for the sake of Fannie and Freddie, which does understandably seem odd, they don't necessarily look at reserve balances as far as other regulations that I've read. They are simply looking at the reserve contribution. So I don't think they're factoring in what the balance is at that time, but when you're looking at an actual reserve study, again, if you're starting from scratch, they're going to say, this is how much money you have right now, year 2026. So if you have $50,000 in reserves and we factored in that you have to do your roof in 2 years, your water heater in 4 years, and all that put together, this is how much money you need to put aside for 2027, 2028, and they're going to like tally that up to the sides. Like if you put that much in, this is how much your balance should be. Because reserves, ideally speaking, should always be separate than your operating expenses. Operating should always come from your operating account. And if you're putting money into reserves, that should just stay there, hopefully gaining a little bit of interest. And you're ready for those future years when it comes to the high level maintenance things that come up. Hope that answered your question, but I'm not sure.
Thank you. Can a special assessment count towards the 15% reserve transfer requirement or really just meet the reserve study recommendation?
I don't think they're going to like that. They're going to ask more questions about that. And I think the biggest question is if you're going to do a reserve study, if you're going to do a special assessment to try to meet the reserves, why not just put that into your regular assessments? And I understand there is a strategy somewhat to separating those two things, but I think when it comes to lending, they're going to look at it more of you're unprepared and you're trying to find a loophole. So it's not something I would recommend. So I think they're going to default to regular assessments and the reserve contribution from the regular assessments. If you're funding reserves through a special assessment, that is telling them you're unprepared. That makes sense.
Yeah, plus they may add the regular assessment income and the special assessment income as your total income, which would adjust your 15% threshold potentially.
I guess that's possible if you're trying to do it that way. They could look at it like that, yeah.
Yeah, and we could probably just, one final question to wrap up, potentially hot off the presses, or has anything changed in housing legislation that may have been passed by Congress yesterday?
Oh, I haven't heard anything about that as of right now. So I don't know. I will investigate what that is. If it does have a serious impact, we'll send it out in a blast. If it doesn't, we'll just make sure our team is aware of it and prepared for it. And if it needs to be communicated to all our board members, we'll do that. But appreciate you bringing that up. So I will research that to see what you are referring to.
Yeah, thank you. And, we do work with legislative committees and things like that regularly communicate with us. So if anything was pointed out yesterday, we'll certainly learn of it very soon, if not already. So that's about it.
We will be made aware. All right. So, show my face. So thank you again for everyone who attended. I really appreciate it. Really appreciate the questions. I guess stated, we'll review all the questions as well. We'll keep you up to date on all of this. And please feel confident that we got you covered. That's why we're here. We're going to take care of these things for you, and we're going to pull you in when we need you, but hopefully that is rare because we know your time is valuable, especially as volunteers. So thank you for everything that you do, and we will be in touch very soon. Hope you all have a great day.